Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
We are about 2 minutes away from the end of the trading day. Caroline Hyde, Taylor Riggs, Sonali Basak, counting you down to the closing bell. Here to take us beyond that bell. With the global simulcast, as always, Carol Massar and Katie Greifeld's in for Tim Stenovic, bringing together our TV, radio, and YouTube audiences worldwide. We dig into what drove trade, and it feels as though we're worried about the economic picture, but big tech manages to drive us higher.
Yeah, once again, right? We've seen this picture before. I'm thinking a lot about what the retail earnings this week are going to tell us about the consumer and the health of the consumer. Hank Smith over at Haverford Trust, that's certainly on his mind. He says what Walmart has to say. He knows that we've seen a shift in spending away from goods to services, but he wants to see how healthy the consumer is, Katie.
I'm also keeping an eye on energy because big tech obviously powering the benchmark indexes higher, except if you look at energy, it doesn't show up again at the index level, but that sector really taking a beating again as oil prices fall after that just rough data from China.
And you see that, and that sort of highlights a lot of the caution that we've received on the TV side of things, Sonali. I know that a lot of the guests we have at the top of the 2 o'clock hour and the 3 o'clock hour, and our last guest as well from UBS, really highlighting that they're not sure that the equity markets have room to go much higher from here. And you have to put that back into the equity markets, maybe the sort of like the lack of demand that we continue to see.
Yeah, the lack of demand, and you have to remember that some of these energy companies are really what drove the S&P in the first place. Just to see that relative weakness recently, Taylor, it doesn't mean much. The year's not over. There's still so many catalysts ahead.
I mean, just to think that we're still on tenterhooks about a Walmart that was only 3 weeks ago, they basically pre-announced and cut their earnings outlook. How much more rich can we get in terms of a picture from them as to how the consumer feels right here, right now? As we look towards all of that data later in the week, we still digest the data on the day, a manufacturing print, a Chinese data that looked pretty woeful. But the S&P 500, as the bells ring, manages to push up 17 points. We are just in a breath away from 4,300. We're at 4,297 is where we settle out.
No confetti for you.
So close, but no cigar. NASDAQ up 0.6%, up 80 points. Dow Jones Industrial Average up 0.4%. That's 151 points. And Taylor and Carol, we look at a Russell 2000 that actually managed to push into the green too.
Yeah, exactly. But it feels a little, like I sometimes like to say, a little bit tortured. If I look at the S&P 500, 285 names in the index higher today, 213 lower, 5 unchanged. So Taylor, it shows you that investors not all in, some down, some up. It's kind of almost an even split there.
Yeah, and you really see that on the sector level as well. It feels almost even, but a little bit of a tilt here to the upside. Really looks, in a way, sort of a little bit defensive, Carol, to your point. Household and products, food and beverage, food and staples, the retail utilities. Those are sort of the big gainers on the day from a sector level. 8/10 to actually 2.5% higher on the day. There are still some laggards, and Katie, I do this for you. Energy, of course, the clear loser, transportation as well, and some of the dividend financials and banks. Those are off almost 2% as we continue to talk about an inverted yield curve and what that means. So, Carol, you're right in terms of sort of maybe 50-50 almost split here.
All right, so you did the sector groups. Let me get to some of the individual gainers in the Monday trade. Disney, we've been all talking about it all day. That stock finishing off its highs of the session, but still with a gain of more than 2%. Had to mention, we know in a letter to Disney CEO Bob Chapek, activist investor Dan Loeb saying he acquired a stake in the company. He's looking for ways to create perhaps more magic in the Magic Kingdom. Geeta Ranganathan joined us from Bloomberg Intelligence. She said, why would they want to spin off ESPN? $4.5 billion annually in cash flow every year. It is so important to Disney's top and bottom line. Wanted to mention Illumina as well, top in the S&P 500, number one, also top in the NASDAQ 100, up almost 9% in today's session, really reversing that decline we saw on Friday when it lost about 8.5%. Morgan Stanley adjusting its price target down to 240 from 350, maintaining equal weight. Not sure that there was a catalyst today, but the company's CEO did talk to Time, which published an interview yesterday talking about how the company is well-placed to witness the world's next great scientific transformation. So maybe check that out. Tesla, wanted to mention, up more than 3% in today's session, also top in the S&P 500, NASDAQ 100. We did see some of the hedge funds either buying or selling shares of Tesla. Also, the flagship Japanese financial media Nikkei reporting that Panasonic boosting its EV battery output for Tesla by 10%. So maybe some enthusiasm there, but definitely an outperformer, Katie, in today's trade.
Well, on the other side of the trade, of course, we've been talking about it was all about energy. You had crude oil falling by about 3.5% after that really ugly data dump from China. That is hitting the likes of Schlumberger, of Halliburton, again, all those big oil names under pressure today. And I also wanted to highlight Warner Brothers Discovery taking a dive down 4% or so. That's after a headline crossed the terminal that the company is going to fire about 70 workers who work at HBO and HBO Max. It's the latest round of cutbacks, of course. And again, this is the data, or the stories rather, that aren't showing up in the data yet when you think about that blockbuster NFP print. But I feel like we've read some version of this story plenty of times in the past few weeks.
Yes, certainly across tech, across real estate. But going back to your data that is factoring into the market, that Chinese data that affected Schlumberger that you pointed out there, Katie, well, it affected and dictated cross-asset moves. I'm looking at global macro movers. For our radio audience, it is a sea of red on your global FX vertical because in large part the US dollar strengthened throughout the day. We got a movement from the fears of an economic slowdown in China and certainly that manufacturing data that came out from the New York number as well that meant that the Canadian dollar, the Kiwi, the Swedish krona, the Aussie dollar, you name it, weakened versus a US dollar that really gets pushed higher in search of a safe haven, in search of perhaps the fact that really we're only going to have hawkishness coming from the US overall. So we are still seeing, of course, that focus on the FX market that also fed into the commodity space, because when you've got a stronger dollar, it means you pull back a little bit in your commodities. Brent crude off 3.5%. In fact, WTI crude having its worst day since the start of August. That, as the Bloomberg dollar index, has its best day since the start of August. So it's really very much a correlation within this. WTI off by 3.4%. We're at $89 a barrel, basically. But big metals fell as well. I'm looking at steel off by more than a percentage point. And really a bid to the haven that happened in the bond market as well, Taylor. European yields sinking. Gilts, for example, over in the UK, 10 basis points lower.
And you really see that in the U.S. as well. Pretty stable, though, across the curve between 2s and going out to 20, about 4 basis points lower, a parallel shift downward in yields, except you go out to 30 years and it's unch on the day at about a 3.11. So some steadiness out there. But Katie, this continues to highlight the theme of what 41 basis points of inversion on the 2s, 10s is still positive sloping 3-month 10-year, but it is the lag that has people really talking, the lag between what an inversion means for an impending recession months to follow.
Yeah, and actually, we were talking about how this would be sort of the weirdest recession ever, of course, with Hank Smith. But it is interesting to see that actually it was the 2-year yield leading gains today, that yield actually going lower. We haven't seen that in a while. Just goes, again, to show that Chinese data, sort of these worries about demand, what that will mean for other central banks, including the Fed. Maybe, that pivot becomes more of a possibility.
Yeah, I think it's so interesting, that volatility in the 2-year, because you were talking about it slipping the yield. But then by the end of the day, we were back up to 320. And so do investors view the U.S. as a safe haven or not? At what point do the Chinese economic data create better or bigger problems here at home? And to what extent are we kind of going to grapple with all of these offshore profits that are stung by the dollar?
Yeah, and how soon does maybe what's going on in the U.S., if there is a consumer slowdown in terms of purchasing more goods? We know China is such an export-led economy. We were talking about this with our Doug Krisner of Daybreak Asia, and that just provides more problems, not only for the U.S. economy, but also the Chinese economy. Having said that, pushing forward retail earnings, retail sales on Wednesday. This is going to be really important. Retail stocks, man, they have really underperformed versus the S&P 500. So we mentioned Target, Walmart. Both of them have already kind of come out and said some bad news. So, Caroline, I do wonder, does it then potentially, if they show some more upbeat news, could this be some potential for those stocks and those names to actually trend higher this week?
And what about the more luxury perspective? What about the Macy's? What about the Estee Lauder? What about the desire for those at the higher income bracket to pull back too when they're looking at their 401ks, when they're looking at how their stock portfolios have done? Does that start to eat into that part? Because that had been very secure when we hear from Macy's in the last earnings, very much seeing that the solid spending coming from the higher income brackets. But we know that lower income brackets have already been so hurt. And this has been an unequal society once again. Are we going to get any positive music out of Target and TJX? Are we going to get any signs of concern coming from the luxury side?
And Carol, just finally to bring it full circle, China's ability to export deflation, the over inventory that these companies have, the deflationary forces that follow. not smart enough to call peak inflation, but from some of the data points, it certainly looks like maybe we're heading in that direction.
I'd be afraid to call peak inflation because, man, social media just like comes at you real quickly.
Yeah, it's hard to say. But I mean, Carol, what we were talking about earlier is when it comes to peak inflation, it feels like in this case, this is where the Fed actually does care about the absolute level. We talk about the rate of change all the time. 8.5% inflation, though, I would get a little bit worried or remain worried about that level.
It's hard for the Fed to say we've got this covered, folks, and we're still running at, 8.5%. So we have to think about it on a historical basis. That's a wrap, guys. That's our cross-platform coverage or simulcast on radio, TV, and YouTube. Lots coming this week. We'll be back same time, same place tomorrow.